A flagship theme for this year is the prospect of a new world order, which reflects some pushback against globalisation, given the rise in geopolitical risk from deteriorating relations between the US and China, coupled with Russia's invasion of the Ukraine. At the same time, the global economy faces challenges from more established trends of high leverage and transitioning to greener energy. While some of the potential changes stemming from a new world order may only come into play longer term, there are signs that economies and markets have already started adapting. We believe these adjustments reflect a 3G process of a great decoupling, a great reset, and a great volatility. These forces may lead to more investment risks, but also create alpha opportunities as differentiation across countries widens, especially Asia versus the West and the US versus Europe. The Great Decoupling reflects countries becoming less synchronized with one another. Encouragingly, inflation is expected to be lower across most countries in 2023, but it will likely be more a painful adjustment for developed markets than for Asia, given consensus expectations of higher unemployment in the developed world. Growth is expected to slow across most Asian economies in 2023, but by a larger degree across developed markets. So these are further signs of a great decoupling, where China is one of the few countries where growth is expected to be significantly stronger in 2023. Separately, a potential longer-term hurdle for the global economy is the high degree of leverage in the system. We believe that this could drive a great reset of interest rates, where strong demand for debt over time, along with a higher term premium, can push up the cost of capital and drive a rebound in real yields to levels higher than those experienced during the Great Moderation. Equity valuations may struggle for a while with higher yields, while bond investors may start to judge income returns from higher interest rates as attractive. So collectively, these adjustments may gradually bring back some balance to the relative return attractiveness of equities over bonds. The great volatility reflects the transitioning of the global equity markets through a bottoming process that has thus far proved challenging for investors. But there are more favourable indicators unfolding. We have moved to a positive view on Chinese equities as it reopens from its tight COVID policies, coupled with the favourable lagged impacts from policy stimulus in 2022. Additionally, the debt deleveraging process in its real estate sector appears to be in a bottoming phase. Our outlook for Asia is also positive, where equity valuations are even more attractive than China, while growth has held up better than anticipated, in part because inflation containment has improved the bloc's export competitiveness. We are positive on the equity outlook across developed markets, especially the US, with stronger evidence that inflation is coming down and expectations that the labour market may avoid significant stress. In contrast, Europe remains our least favoured region, as its likelihood of a painful recession is greater than that for the US. Notwithstanding our positive assessment, investor concerns have shifted back to the downside risks to growth, with some slippage in real yields and the US dollar. The prospect of weaker growth in 2023 cannot be totally ruled out, but what remains encouraging is that most investors believe the US can avoid a deep recession. In addition, because US equities fell by around 20% from their peak in 2022, some prospects of recession risk may have already been priced in. So if a painful recession can be avoided, this may add to the upside for US equities. Lastly, we have a negative view on the US dollar as the terms of trade has fallen. Higher interest rate differentials in favour of the US is also becoming less of a supporting factor as the Fed converges toward its peak Fed funds rate for this cycle.